Thanks again for tuning in. Now, this episode is just power-packed with money and cash-saving tips from a CPA's expert perspective. My guest today, Mr. JT Pells, gives us all kinds of information, immediately actionable steps that you can take today, maybe things that your current CPA or tax professional is missing, things about your kids working in your business, and monies that you can obviously pay to them and even invest for their future that'll save your company money and will literally have your family work for you financially and in your business. Everything about home office deductions and monies that you might be missing, renting out a space in your home for board meetings and getting a tax benefit. The difference between a tax credit and obviously a tax deduction are huge. And like JT says, a tax credit is like a deduction on steroids. This episode is just full of information that if you're a business owner, a small restaurant owner, even a restaurant group owner, this is for you, so don't miss it. Thanks to our sponsors of this week's episode. Thank you, audience, once again for tuning in. Listen on.
You're tuned in to the Restaurant Rockstars Podcast. Powerful ideas to rock your restaurant. Here's your host, Roger Bodwin.
Rockstars, the busiest time of the year is coming. Is your staff ready for the holiday rush? Well, this year, give your team the gift of Pop Menu AI Answering, a simple solution for phones ringing off the hook. AI Answering handles calls 24/7, 365 days a year, so your staff can focus on in-person guests. Customize your greetings and responses, answer common questions, promote specials and events, and send follow-up links to ordering and reservations. AI Answering handles it all while escalating more complex conversations back to your team. Now, never miss another tasty revenue opportunity. Pop Menu is the marketing technology platform designed to make growing your restaurant easy. Discover more AI restaurant tools that turn your to-do list into an already done list. Request a demo today, and my listeners for a limited time will get $100 off their first month, plus lock in one unchanging monthly rate. Go now to popmenu.com/rockstars. Again, get $100 off your first month at popmenu.com/rockstars. Listen, from one restaurateur to another, and I hope you GMs out there listening as well are paying attention. You know, marketing should never be an experiment. Oh, I tried this or I tried that. No, any of your valuable dollars that you spend on marketing should absolutely be trackable. You should know exactly where the business is coming from and that it's driving return on your investment. You spend a certain amount of money, you want to make far more money in return from that marketing, if you can track it. So pay attention. My friend Dyson runs a business called The Birthday Club, and his program is done for you because we know that everybody dines out on their birthday. It's a tradition. It's a celebration. But not only do they not come in by themselves, they bring many friends with them. They usually have free spending and large check averages. It's very profitable business. So why leave it to chance? Why let your competitors get all the birthday business? So again, The Birthday Club is a done-for-you program. All you have to do is check out www.jointhebirthdayclub.com/birthdayrockstar. It's a great program. If I still owned and operated restaurants today after decades, it's something I would definitely be doing, but it's worth checking out. So check it out. jointhebirthdayclub.com/birthdayrockstar. Hey, JT, welcome to the show today. How you doing? Thanks for being here.
Yeah, thank you, Roger. I'm doing real well. I'm excited to be here, and we're going to talk about some good tax and accounting strategies for a lot of the restaurant listeners or restaurant owners that are listening to us today. So we're gonna have some fun and give you guys some good tips.
Well, you know, accounting and taxes and tax planning are not the most exciting topic, but you seem like a really interesting guy. And I know that you're going to add a lot of juice to this episode, but it is critically important. You know, putting yourself in the best financial position literally every week, every month, every year is so vital to the bottom line of restaurants because the margins are so slim and you're working so hard. It's like, why not keep as much money as you can? And I know that's your philosophy. So glad to have you here.
No, so yeah, just like you said, yeah, you want to keep as much money as you can. So go ahead.
Awesome. I found your website really interesting because you had some really cool testimonials. And one was, one of the Shark Tank guys said that he'd hooked me up with his accountant. I said, nope, I got my guy. And then another place called you the tax quarterback. So tell us about, there's some personality behind that, but clearly
Yeah.
people really welcome the advice they've gotten. You've saved them lots of money. You've made a big impact in their businesses. But why the tax quarterback? Is that kind of a moniker that now you sort of hang on the wall?
A little bit. I have to give credit to my partner Drew. He's the one I think that kind of came up with it. Both did. I think I said it to a client, or maybe he did, where the client was complaining, saying, I get this advice from my accountant or my CPA, but they just like give me like really vague generalities, like, you should do this, you could do this, you can do that, bunch of if thens. So I said, well, I'm going to quarterback this for you. You're going to do this, this, and this, and I'm going to do it for you. How does that sound? And he's like, okay. And I think when I said the word, I'm going to quarterback it for you, that's how it came. And now I tell people, I'm the quarterback, you're the receiver. I'm just going to throw it to you. All you got to do is you run to where I tell you, you catch it and go from there. Because I've found that I've been doing this for years. Most CPAs, like I said, they just give you the if thens. Well, you can do this if you do this, if you do that. It's like, no, tell me what to do. I'm coming to you. So I think that's how it started.
Now, every accountant or CPA has to follow what is called generally accepted accounting principles. And some are more conservative than others. And there's always that question of how far can we push things without stepping over the edge where we become audited or we're in some sort of legal challenge that, and a lot of restaurant owners, based on the margins, want to push the envelope. Is there a fine line between pushing the envelope or what is really something that you can do and it's not a problem? Like in your best advice?
Actually, so I like what you said. GAAP was good, generally accepted accounting principles. I actually tell people I'm the most conservative accountant or CPA in the world. I just follow what's in the Internal Revenue Code. And we actually tell people the Internal Revenue Code, or IRC, is actually a playbook for people to live low taxed. We just follow everything that's in the guide. We don't toe the line, we don't cross it. We just say if the IRS allows it, we take it to the fullest extent. So that's why I tell people, and I tell them, as long as you're not doing anything illegal, doing anything shady, you have nothing to worry about. I'm here for you, and I'm going to tell you exactly how to do it.
Okay, that's cool. So what should our audience expect to learn from you today? I mean, we're going to cover a lot of ground, of course, but what's really, really important, and what do you want our audience to take away from today's episode?
I think it's the biggest thing I want people to know is that you can significantly lower your taxes by doing things you're already doing within your business. So that we're going to help you kind of uncover things that you're doing. We're just going to kind of help you record them essentially on your books and how to go about that. And that I'm pretty good at generally looking at a tax return from somebody and pretty much picking out about $20,000 to $30,000 minimum that you could rearrange, and I'd say save in taxes. I'm pretty good at looking at a return.
Okay, well, here's a question for you.
Yeah.
A lot of our audience have been working with a tax professional for years. A lot of our audience are just starting new restaurants or new businesses and that sort of thing. Does it take time for someone like you to really understand someone's business and perhaps their past tax returns to really understand how you can help them best? Is there a learning curve, or you just have so much expertise that you've seen things 1,000 times before, you can sort of make connections between what they've done, what they might have missed, and immediately be able to understand the business in order to help, if that makes sense?
It's a little bit of both. For the most part, in terms of accounting and taxes for restaurants,
Yep.
everyone's pretty much the same. There's not like Chipotle is going to have the same accounting or accounting practices that like a mom and pop shop is going to have, maybe a little less waiters, but for the most part, the accounting side is going to be pretty similar. Normally what I like to do is I like to look at your past 2 or 3 tax returns just to kind of see, what type of entity you have, basically what you're not doing. And kind of like I said, within the first 5 to 10 minutes, I can pretty much pick out about $20,000 to $30,000 in deductions that you should be doing now. So
Oh, you got my attention.
Yeah.
That should get everyone's attention. It's like,
Oh
okay,
yeah.
that's gonna move the needle
Oh, it's huge. Yeah.
on your situation for sure. So you've got sort of a slogan about living tax free. Tell
Mhm.
us to the extent that that's possible and sort of explain what you mean when you say that.
Yeah. It is very possible to live tax free. It does take work. I'm not going to sit here and lie
Mhm.
and say I can just do some witchcraft and there you go. You don't have taxes. It does take work. But one of the ways is kind of like I said, making your personal expenses business. Now, now I don't mean by lying or anything like that, but
Mhm.
here's
Mhm.
a real easy one. A lot of
Yes.
restaurant owners actually don't do this. A lot of restaurant owners don't take advantage of the home office, right? I'm sure you're at home. We actually had a client. They're in the Midwest here, and then I asked them. I said, "Do you guys have a home office?" She's like, "Yeah, kind of." And I said, "Well, what do you mean, kind of?" And like, I'm really good at asking and probing these questions. And the more she explained it, she's like, "Well, actually, in my garage, right when the shutdown happened, um, we knew a supplier, and we bought like, I went out and bought an industrial fridge, put it on my garage, and I stored meat because I didn't know when we'd have it, and it was huge. It took up. I was like, oh, well, then you do have a home office because now like half your garage is your workspace." She's like,
Uh-huh.
"Oh, I never thought of that." And then I kind of see her smiling, like, "Oh, I never thought of that either." Um, and then same thing with her home office, like, "Yeah, I have a home office, but I thought that I couldn't have one if I have a retail or a physical space." And I said, "No, that's not true." We looked right in the Internal Revenue Code, and I said, "Here it is. It's right there." She's like, "Oh my God, I've been missing." She's like, "What do you think I've been missing in deductions last year?" I'm like, "Well, I'm guessing you could probably write off at least $600 or $700 a month in your home office expense." And she's like, "So that's what is that, like $7,000?" I said, "Yeah, probably." She's like, "Oh my God, I've just missed like $20,000 last 3 years." I said, "Yep." Then there's other ones where you can actually, if you own your home, you can rent your home to your restaurant to have board meetings, to have team parties, to have social media shoots, and it's all tax free and tax deductible to you.
This
So
is
then,
great stuff.
yeah, and like that's why I say it's personal stuff you're already doing, right? You already have a mortgage.
Mhm.
You probably have a business partner. A lot of times it's a family member.
Yes.
You're probably coming over to discuss business. Well, now you can just rent your house to you and your partner to have a board meeting every month.
Let me ask you, let's take that a little
Yeah,
deeper.
yeah,
We'll talk about the home office deduction. We'll
yep.
talk about renting out your house for board
Mhm.
meetings and that sort of thing. Do you have to specify a certain accurate, fairly accurate square footage of the space actually used and then apply that to not just the rent, but say a portion of the utilities and the
Mhm.
maintenance expenses and all that kind of stuff, depending on the percentage of that square footage to the total square footage of the house itself?
Yeah, you hit it right on the head. So you
Okay.
would take, let's say your home is 1,000, just for easy numbers,
Hmm.
1,000 square feet, and then you determine that 100 feet of that is used for your home office, fridge, or industrial fridge, whatever you're doing.
Yes.
So then you would be able to take 10% of your mortgage interest, your rent, HOAs if you have them. Basically as I say, any shared expense. So like I said, your mortgage interest, rent, HOAs, utilities, if you have a cleaning service come in, insurance, things like that. So we typically find that most restaurant owners aren't doing that because they've never been told, and kind of like I see you kind of nodding your head a little bit.
I've never
It's
done that. I owned
Yeah,
restaurants for 20 something years and I
yeah.
never got that advice. So thank you.
It's no, and I find that a lot of accountants, and you can tell me if this was in your
Mhm.
particular case, most accountants most business owners meet with their accountants like, March 15th, right before the deadline. And at that point, it's kind of too late. Like I
Yeah.
can't go back and say,
Yep.
"Hey, Roger, remember, like, did you do that last year?" No. Okay, well, let's do it this year. And then I'm going to go talk to this next guy who's coming in 5 minutes. So, Roger, see you later. Here's your taxes. Here's Joe. Done. And you're like,
Right.
what did JT just say? I have no clue. And then you're like, "Oh, I'll wait it till next year." Then you come in. It's a vicious cycle
Yeah,
with
we
these
always
things.
we always sat down and did tax planning like early November.
Okay, perfect. Yeah,
So we could go back and make changes and shifts
exactly.
before we closed the books out, before I
Correct.
then turned it over to my CPA. So sure, that's
Correct.
really good advice also.
Yep. Yeah. You want to be meeting, and I have different restaurant clients where we're meeting, some meet monthly, some meet quarterly, and like
Mhm.
we're reviewing the books and say, "Hey, like what's coming up? What's down the pipeline?" Like, and we would just want to be ahead of it because, you know, it, it does happen fast. And, as we're talking here in August, we've got 5 months left. So if you don't have your books up to date, if you haven't been writing off your home office, like we got to do that now. Like this is the time to do it.
Yeah, we always found November was a good time because,
Yep.
90% of the year was over. He could see our revenues, he could see our expenses, he could see what we might be missing. And yeah, we got really good tax position advice doing that. This whole board meeting thing triggered another thought. Everybody that owns a restaurant or a small business of any kind has a car. They're probably paying a car payment on it. Can we deduct that for the business if it's, say, lettered with logos? Because I'm a huge believer in brand building. And I drove a pickup truck that was lettered from front to back with a logo of our business and our website and all that kind of stuff. And there was there was a deduction there. Granted, the company owned and leased my vehicles, which has some sort of a connection there. But let's just say the average restaurant owner listening to this is driving a car to work. How can they get any benefit out of that car if the company isn't actually paying for that car? Do you suggest that the company buy the car or make the payments if they logo it up? Or what would you say that?
The easiest way I would say is, so one, if you just have one car for yourself, and there's one car that you're driving to and from the restaurant, and then you obviously have your personal stuff, like you take your kids to Little League.
Of course.
I would not have the car. I would not necessarily have the company buy the car. There's a few reasons why. One, your insurance will go up because now you're driving a commercial vehicle rather than a personal vehicle.
Thank you. Yep.
Putting the logo on your car, it actually doesn't make it 100% deductible. There's been court cases all around for years. Now the logo is deductible, but it doesn't mean that every second you're driving it's advertising.
Sure.
So that
personal use versus business use.
Yep.
You need a percentage again of how many miles a year are you driving literally business legitimate purposes versus I'm driving the kids to Little League.
Correct. The easiest way I would tell people to track their miles is, I know it's tedious. It's like, I'm not going to sit here. There's actually an app. It's called Mile IQ. I think it's like $30 a year. And as long as you're driving with your phone, which now that we're all driving with them,
sure,
I'm guilty of it too. Sometimes I'm looking at it as I'm driving. It's not good. Don't do that. But as long as you have it, that phone will track every single mile you drive. So now you don't have to. Now you can take that report. You could turn it into your CPA, your tax preparer, whoever's doing it. Like, oh, how much did you drive? Here it is. And it's totally backed by the IRS. So I would say it's the best. And then you'll know how much you can write off on your taxes each year.
Okay.
So that's the way I would do it. If you have a separate car, then by all means you can have the restaurant drive it. You can have the restaurant own it and lease it, like you said. There's benefits to leasing it versus buying, but for the most part, as long as you have a car that's used 100% for business, you can have the business own it.
Excellent. Great advice. What common mistakes do you see, say, restaurant or small business owners making that you're like, you kind of shake your head and say, I can't believe it, but it comes up time and time again. And suddenly the light bulb goes off when you tell them and you're like, oh my God, I've been doing that for years. Eureka. It's like, thank you. It's like, do you see any common mistakes, things that people should absolutely be doing aside from what we just talked about with the home office thing and renting out your house?
Those are ones. I think an easy one is bookkeeping. A lot of restaurants don't do it throughout the year. So I get a lot of, and whether it's restaurants or not, they come to me, new clients will come to me in June and I say, okay, what are you making this year? And it's like, I don't know. And I was like, well, can't plan if I don't know, but I'm actually going to give you one better because everybody says bookkeeping and obviously it's very important. Like that's the backbone of everything. But one, I think that every restaurateur and business owner, regardless, and I may not make a mistake, but doesn't know. And I want to go back to what I said about doing things you're already doing, just not using them tax advantage wise. Every business, I always tell them, you should hire your children to work in your business. Now, that does not mean that they're carrying around plates at 5 years old. That's not what I mean. Not anything like that. Nothing dangerous. But restaurant owners are actually in a very unique position where you can hire your, I don't know if I'd say infant, but let's say under 7-year-old kid to work in the business. Taste testers. It's a real job. You have to taste the kids' menu. That's real, right? You're not going to just make something and put it out and not taste it, right?
Excellent.
There's real jobs. So you can actually pay them. It's tax deductible to your business. It's tax free to them up to $13,850 this year. So you can get a $13,850 tax deduction this year. You can pay it to your child, who will also not pay taxes on it. And then they can take that money, put a portion of it into an IRA, a Roth IRA, where it's tax-free again. If you do that for 17 years up until they're 18, that will easily turn into like $4 or $5 million.
Wow, that's huge right there.
Yep.
Oh my gosh.
Oh yeah. And every kid works in their parents' business in some way, shape, or form.
Oh yeah.
In some way.
Yes.
Right. In some way, shape, or form. So you can do that. Now it's a real job. They're going to have a job description, a W-2, all that stuff. You're going to have an agreement. Money changes hands. It goes from your business to their personal account. But that's something. And then you can actually have your kids pay for their little league out of that. They could pay for groceries. So now you've just made your kid's going to buy, you're going to have to buy groceries for your child, right? They're going to go to little league. They're going to go to camp, field trips, all that stuff. So now you have just turned little league into a tax write-off, just because you took a little bit of time and said, well, they're already working for me. I can just pay them. Oh. And now you've kept that money in your business, in your family.
In your family.
Instead of going to the IRS. Yep.
Is there an age in different states? I mean, can kids do this at age 15, say, because that's the minimum working age with a school work permit kind of thing? If your kids are literally, I mean, tell us about that boundary line.
I don't know about every single state. I'm here in Iowa, so I'll say how it works here. And I know it works in the neighboring states like Nebraska, Minnesota, South Dakota, and Missouri. And I'm pretty sure most states are similar. If you're working in your parents' business, you can work basically from the time you're born, because we have a farming history. So like when you had kids in the 1800s, it was to work on the farm. Right. So here you can work in your kid's business, in your parents' business as much as you want, because from the local authorities, from the unemployment and labor boards here in Iowa, and I know the neighboring states, is your kid's probably not going to sue you. And you're also probably not going to have your kid like dumpster diving or like doing something dangerous.
Sure.
So they're like, now you can't go work for somebody else, but they can work in your business.
All right. That makes perfect sense.
So I would say for most states, I know Wisconsin is similar. I know Illinois is similar to that. As long as you're working for your parents, you're going to be fine.
Yeah.
Honestly, most states aren't going to care, because it really is up to the kid to complain.
Sure.
And I just really don't think you're going to put your child in a dangerous situation.
No, of course not. But this is really immediately actionable advice, and it's good advice that most people have not heard before. No. And the last one, wow. I mean, you got to plan ahead for your kids' futures, and what an amazing way to do it. I mean, wow. And again, exponentially over time, money grows, and by the time your kid's graduating from high school, if they get a couple $1 million in the bank, I mean, whoa, that was very powerful information.
Oh yeah. And it's not only that, you don't have to put it in a Roth. I know I have clients, they had an infant child last year. They do dog training, all online dog courses, and their kid is in the videos. Like some of the training videos have to do with like how to like train a dog to behave around an infant. Their infant's in it. So they, at the age of, I don't know, 6 months, I guess, they made like $12,000 or $13,000 just for being in the videos. It's still all recorded. They get, W-2 at the end of the year, and that money is just going to sit there. They don't want to put it in a Roth because they're not sure if they want to do that, because their financial advisors told them something different. But I mean, even if it just sits there, that's like it's going to be well over 100. That's going to be like $250,000 or something that they'll have when they're 18, just to they want to buy a house or go to college or whatever.
Oh, that's phenomenal. Let's talk briefly about Roths versus traditional IRAs, because business owners can sometimes catch themselves in cash shortages, or the unexpected happens like the pandemic. And you might have a significant amount of money in a traditional IRA, and now suddenly you need to pull money from somewhere, and there it is, but there's a penalty attached to that unless you're at age 65, if I still understand the rules. But a Roth IRA is completely different, where you can put the money in and take it out. Like, why is there such a difference between a Roth and a traditional? What are those differences, and why is there no penalty or little penalty for taking money out of a Roth versus a traditional? Could you give us a sort of a crash course in IRAs?
Yeah, the kind of 50,000 foot overview. So traditional IRA, when you put that money away, you get an immediate. So if you put, I think the maximum this year is about 6,500. So if I put 6,500 in a Roth, in a traditional account right now, I get to take $6,500 off of my taxes this year. When I take the money out, then I pay the taxes. So that's why you're saying, so you feel like you're getting punched. It is, because you're paying the regular tax rate, which is like, 20% for most people. And then on top of that, you're getting another 10% early withdrawal penalty. For a Roth IRA, I can put the same amount in, 6,500 or about 6,500. If I take that money out, I don't pay the income tax. I've already paid it. I would pay the 10%. So that's why it doesn't feel like nearly as much. Those are kind of the easy ways. I actually, depending on the age and the lifestyle of my client, I actually don't recommend IRAs to most clients. I actually don't do that because, like you said, I don't like tying that money up. And it's just like, oh crap, like you said, what if something happens? And it's like, shit, I gotta wait another 20 years, and then or I have to pay this penalty. Now, obviously, you can borrow against it, but there's a limit. It's only $50,000. You have to pay it back within 5 years. So I actually like to have clients diversify in what they do. Now, I'm not a financial advisor by any means, but I work with a lot of them, and they kind of help my clients navigate what they should be doing with their savings.
Let's talk quickly about the employer retention tax credit, because there's been so much hype about that. And so many owners it's been like a Hail Mary for our industry for so long. But I heard a statistic the other day that like 80% of businesses out there, whether the restaurants or small businesses, still haven't taken advantage of it yet. This program has been going on now for about a year and a half. Do you come across that much? Do you see that the people you work with have taken advantage of it, or there's still people that don't know what it is?
I would say it's about half and half. I would say most people know what it is. I would say about half the people have taken advantage of it. Half the people have been told they can't. Now I'm going to stick specifically to restaurants.
Yes, please.
Most of them qualify is when it came out, about 2 or 3 years ago, or no, during the pandemic when it came out, there were basically two criteria. If you had a loss of revenue, which most people did, then you qualified. There's different markers, but long story short, if you made less money over compared to 2019, or if you had a shutdown, like if your business was shut down by government ordinance, which most restaurants, or not even shut down, just changed, which all restaurants were changed, right? You had to go to all takeout, maybe all outdoors. If you're in California, shut down. So most restaurants just inherently qualify. Like it's very hard to not qualify unless you open at the end of 21. But as long as you kept your staff on payroll between April of 2020 and September of 2021, you do qualify. And like you said, there's some pretty big numbers. Like I just had a client, they got approved, I think, for like $80,000 or $90,000. And they were like so happy, and they were like, oh my God, thank you for recommending us to do this. Cause like our last accountant told us that we didn't qualify. And I was like, no, pretty sure you do. I had another restaurant client, they just got approved, I think, for like 55,000. So it depends on like how many people you have on staff, how long you kept them. So there's all kinds of qualifications. But I would say if you're a restaurant owner and you're listening to this and you have not applied for it, definitely try. Like just ask your accountant, they'll tell you. And if not, you can always ask me. We have a landing page, something special for all of our guests, all of our listeners on this episode, and we'll throw it out at the end. But make sure you sign up for that, and then you can get in touch with us if you've been told no. Because, like I said, most restaurants are going to qualify. I can't think of any that wouldn't qualify as long as you kept your doors open, you kept people on staff from 2020 to 2021. You're going to qualify, and we do want to start applying for it because I think after basically December 31st of 2023, you lose out on half the credit for 2020, and then next year it sunsets. So we want to be doing this like now. And it does take about 5 to 6 months to get back. So guys, if you're listening out there and if you haven't applied, please do it ASAP because like Roger said, it's free money. It's a lifeline. Now you do have to amend some taxes from the years back. You might owe a little bit of taxes, but for the most part, it's free money. If you're going to get back $80,000 after paying a little bit of back tax, you're going to walk away with like probably 85% of that. And who couldn't use 85% of $90,000?
Exactly. It was a lifeline for, before the pandemic, I bought another restaurant, not knowing what was coming. And I've been through all that sort of thing. And it was definitely a Hail Mary for our business for sure. And we got a significant amount of money back. So yes, thank you for your advice. And if you haven't done so, now's the time before things change. really quickly. So that's great. Let's talk about your style. And
Yeah.
when you start to work with a new client, like tell us through
Mhm.
the onboarding process, the get to know you process, because you're a very personable, friendly kind of guy. Like there's trust there just in me talking
Yeah.
to you. But tell us about how you work with a new client and how long that process takes, and then how you get them comfortable with your style and your
Mhm.
approach to tax planning and tax preparation.
I think one thing, from first meeting before they onboard, one thing I like to tell people when they first meet me is if you don't know anything about taxes, it's okay. I'm not here to judge you. I went to school for this. I have an accounting degree, CPA license, all the fancy stuff. You guys didn't, and it's okay. Please ask me any question. And if you have to ask me the same question 4 or 5 times, that's on me. That means I'm not explaining it correctly. I'm not walking you through it. So I immediately put people at ease when I say that. And then I normally say something, like that's why people like working with me, because I'm not here to judge you. I'm not here to make you feel stupid. Some CPAs, some accountants will be like, God, Roger, what are you doing? You didn't know to commingle your stuff? Like, that's stupid. It's like, well, no, he's trying to, his job is to go make money, not to be an accountant. That's my job. So I immediately put people in and say, please just relax. I'm not here to chastise you to make you feel stupid. I want to work with you. I'm on your team. And then after that, we kind of go through, I look at the books, kind of see where there's room for improvement that could benefit you. Most people are doing it right for the most part. They're just not optimizing it. So I go on and optimize it, kind of like I said, hiring your kids. If you have 3 kids, it's $30,000 or $40,000 that we need to write off. Like you said about the cars, if you're driving to and from work, we need to make sure you have that home office to get that back. And generally, like I said, I can pretty much find people like probably somewhere in the neighborhood of like $30,000 right away. So and
Yeah,
then
that's
people seem
great.
to like that. They're like, oh my God, I've never thought about that. And we actually didn't get into my favorite part, which a lot of people don't do, are tax credits. Now, so a lot of people say tax credits and tax deductions, they kind of use them interchangeably. I'll say this, I'm not going to go into the nitty gritty of it, but the easy way to say it, tax deductions, tax credits, they are tax deductions on steroids. I will say that. And
I like that.
restaurants are a treasure trove of tax credits. I'm going to go over 3 really ones that get missed a lot for most restaurants. Number one, and I would say for all the restaurants you've owned, would you say that you've had a lot of tipped employees?
Yes, tremendous
Okay.
amounts. Probably 50 in my largest restaurant were tipped employees.
Okay. So if you have tipped employees and you're reporting it on their W-2, which you should be, and if you're not, we'll go back and change that. But if you have W-2 employees that receive tips, you actually get a tax credit for that. So I'm going to give you an example. One of my clients, they're open, I think, 4 days a week from Thursday to Sunday. And they have, I want to say like 5 or 6 tipped employees, waiters, waitresses, bartenders. And they actually qualified for like $15,000 in tax credits every year. They were never taking them. And I was like, wait a minute. Riley, why are you not doing this? Like, I don't know. Nobody told me. And I was like, so we went and amended, and he got back like, you go back for 3 years. So it was like $45,000 in tax credits that they got that they didn't know. And every restaurant that has one, you guys qualify for this. So make sure you ask your accountant. It's called the FICA tip credit. Everybody applies. Everybody has them.
Yeah, we definitely got that in all of our restaurants for sure. But I'm a little surprised to hear that other restaurants aren't getting that if they have tipped employees. I mean, who have they been working with? It's like, yikes, that seems like a really basic thing.
It's a lot of it is, so if you use a payroll provider, like Gusto, ADP, they actually prepare the forms for you.
Yeah.
It's just that, like you have no idea. And your accountant, if you go to them in April, they're just like, hey, Roger, give me your P&L balance sheet. And you give it to them. They didn't ask you for this other form that your payroll company. So then, they're trying to do it at the 15th hour or the 25th hour. And then you get one. So they don't know most restaurateurs don't know to ask for that. So if you have a payroll provider, I use Gusto for a lot of my clients. They calculate it for you. Just ask them for it. They'll send it to you. Give it to your accountant. The next one that a lot of them don't is the research and development credit. Now you might be thinking, research and development, I'm not building spaceships. What are you talking about? Au contraire. If you're a restaurant and you brew your own beer, you actually get to take a tax credit for that.
Wow.
Because it's unknown. So a lot of restaurants, if you're creating new restaurant items, new menu items, that counts too. So like I said, it's things you're already doing, but most accountants don't specialize in that. So those are the two. I would say the
Yes.
third one is another called the work opportunity credit. So if you hire, there's a whole bunch of classes, but basically if you hire like somebody that was in the military,
Yes.
if they just got out, you can take a tax credit for them up to, I think, like $10,000. Different, and then other like disadvantaged backgrounds. Like if you have people like on EBT cards, if you have people on like that just got out of prison, stuff like that. So those are three that restaurant owners typically qualify for in some way, shape, or form, but they just don't. So I see you smiling there. I mean, I had a client that had 15,000 in FICA credits. They had like 20,000 in R&D. I think they had like 5,000 in like WOTC credits. So right there, that's like off the top of my head, that's like $60,000. And you ask me how you live tax-free by doing that.
Awesome. That's terrific. Let's go back to the tax planning process.
Yep.
I just asked you how you start to work with a new client and understand their books. Would you recommend that you start working with them on a quarterly basis as the year goes along? And what should they be doing every quarter, say, to be in the best position by the end of the year?
Yeah. So I would definitely be meeting with most of my clients, they meet with me either quarterly or monthly. It just depends on how much they have going on, but at least quarterly. And then you want to keep your books updated. Now, what do I mean by that? It's your QuickBooks. If you have I recommend having a separate bookkeeper. Don't try to do it yourself. That's not smart. It's obviously, it's not the best use of your time. It's actually a terrible use of your time. Two, and it becomes accurate. The reason why you want those books accurate is when you come to me or your accountant or whoever you're working with, I need to know how much profit you're making. Because if you're making a lot of profit, I'm going to tell you something different. If you're losing money, I'm going to tell you something different. And if you're giving like half-cooked books, I'm giving half-baked advice, and nobody wins. So
Sure.
Kind of like that. Then the other thing is you want to open up to your account. You want to tell them exactly what's going on in your life. Kind of like how I talked about, like, are you married? Do you have kids? And it's like, oh, are your kids working in a restaurant? Yeah, kind of. Okay, well, either they are or they aren't. And if they are, we need to get them on payroll. Are you using your car in business use? Yeah, all the time. Do you track your miles? Is it owned by the company? No. Okay, we're going to start now. Another thing, like I'm sure you've talked about, is what's called entity selection. If you're an S Corp, a C Corp, we all hear these fancy words. I'm not going to go to like who should be an S Corp, who shouldn't be, because there's all kinds of things, but you want to be asking your tax advisor, is my entity selection correct? And they'll normally tell you. For most, it's an S Corp. For some, though, a C Corp might make sense. For instance, I hear that you just said you bought a restaurant. Here's one for you if you kind of want to do that, or any of your listeners are buying restaurants. If you're in the business of buying a restaurant and you're probably going to sell it, you actually want to be a C Corp. Here's why.
Excellent
Is
advice.
that
Go ahead.
if you buy a C Corp restaurant and you sell it in 5 years, you actually don't pay taxes on the first $10 million in capital gains. So if you bought a restaurant for $1 million today, sold it for $8 million in 5 years, that $7 million is tax-free. But if you had done it as an S Corp, because everybody hears it on TikTok, they don't have that same exclusion. You're like, crap, now I just paid $6 million in taxes, or taxes on $6 million. So that's why, like, I don't blanketly just say be an S Corp, because it's not for everybody, and there's all kinds of reasons why you shouldn't be, but that's an easy one, is you want to look at your entity selection. And then you want to just ask your accountant, like, is there anything else I'm missing? Like the home office, the Augusta, or the renting out your home, the Augusta rule. If you want to set up a retirement account, do you want to have health insurance for everybody? There's all these things, and you want to be asking your accountant. And that's what we're meeting with. That's why I'm meeting with my clients on a quarterly basis. And that's what we're talking about. It's just like, how's business going? What are some different ideas? Like, do you have, like, here's an easy one I think that you would attest to. I always ask clients is, and this is any business, doesn't have to be restaurants, but specific, is like, do you have an email list? Are you taking, like, like we all have the QR codes now on the tables, right, for our menus.
Of course. Yep.
You should be having people sign up. Yep. They should immediately be signed up for your email list when they do that. And now you should be immediately, and don't do this yourself. Have somebody else do this. Set up an email list. And now you have coupons go out. Like who you talked to, Drew, earlier, he does our email list. So people get emails from us I think it's 3 times a week, or maybe 4 times a week. And then all of a sudden they're like, when it's tax time, it's like, you know what? I got to talk to JT. I've seen his emails all the time. And it's going to be the same thing with your restaurant. If you can be in front of your in front of your clientele, your customers, they're going to come in, same thing on there. You can start rewards points or rewards programs on there. So that's kind of the things that I'm talking about. It's not just straight up taxes and like, let's make sure we're saving all taxes, because there's only so much in taxes you can save. It's at one point is what is your CPA bringing to the table? Are they helping you make money?
Here's one for you. A long, long time ago, like most restaurants obviously start out by leasing a space. The majority of restaurants have leased spaces. Obviously, some own the real estate. I'm a big believer in controlling your destiny and owning your real estate. So I leased for a couple of years, decades ago, and then I literally bought land, built a building, and owned the property. And back then, an attorney that I worked with suggested that I separate two different entities, the restaurant operating company from and create a company for the property itself, so that the liability is high in restaurants. Somebody sues you for slipping on the floor, whatever. If you've got all your cash parked in one restaurant company and you're subject to a lawsuit, obviously you could be in a problem. But if that restaurant then pays the real estate property owner a significant amount of rent, and you pull all that cash out of the operating company, all you really have are, basic weekly receipts or monthly receipts. But all the equipment is owned by a separate company, the building itself, and you're literally renting. Do you consider that still to be a sound strategy? And is there a limit to how much rent you can pay? Or is it excessive to say, oh yeah, every month it's $100,000 because you want to get all the cash out of the business? You know what I mean?
No, that's still smart. I tell people that if you're going to buy the restaurant or buy the building, the land that you're going to build on it, you want one LLC to own the building and the land, and then you want the LLC to be operational. So you're going to have 2 or 3. You can rent your equipment to yourself. Okay. In terms of the amount of rent that you want to pay yourself, it has to be market rate. So like you said, you can't just like and you just want to look around, like what are people paying in rent? It's pretty easy to find out. You go on Zillow, you go and just ask somebody too. So if you're a restaurant, here's the one. Let's say you own the building, right? Own the land, own the real estate. Then there's a restaurant next door, and it's a similar size building. You would just ask them, what do you pay in rent? Oh, we pay $10,000 or $20,000, whatever it is. So then your restaurant would pay your LLC $20,000 for rent. Gotcha. So it has to be market rate. Yeah, you can't just arbitrarily be like, it's going to be $1 million. It's like, well, kind of. And there's actually, there's all kinds of actually good tax strategies when you own the building. I can nerd out and talk about it, but if you want to live tax-free, the first year that you buy your building, and if you have a successful year in the restaurant, you can actually pay $0 in taxes by owning the building. There's so many things, and same thing with the equipment. And this is actually a nice trick that I tell people. I do this myself. Every year, I try to open up a new credit card in my business name, because then it allows me to pay 0% for the first year. So I can rack up all these, now not irresponsibly by any means, but if let's say you open up a new spot, right? You should immediately be applying for new business cards, and they might give you, like me, an accounting firm, I think we have like $50,000. If you're a restaurant, I'm sure it's even more. So now I can spend everything on the credit card for $50,000. I don't have to pay it back, or I have to pay the minimum, but I don't have to pay a large portion of it back for a year. And now all of a sudden I've gotten this huge tax write-off for money that I didn't even spend. And now I'm not paying any taxes. So there's so many ways. And I tell all restaurateurs, if you don't have a credit card, please open one up. If you can, open up 2 or 3. Now, again, don't be irresponsible. Don't spend more than you can afford. But you might as well give yourself that cash flow. And if you can, and typically once you've done one, they're going to give you another credit card because you have a credit history built up. So you want to do that, and you want to make sure it's in your business name, not your personal name. So
yeah, that's an interesting.
I'm a big fan of credit.
So was I. There were many times, especially when I was just starting out, that we needed extra cash because things always cost more than you expect. And you borrow
Oh
so
yeah.
much money from the bank to open this business. And then all of a sudden you're short on cash for working capital or slower seasons or whatever. And if you've got a couple of credit cards with zero interest, and then interestingly, if you monitor when those zero interest suddenly turns into 25%, you get these routine offers in the mail from other credit card companies that'll transfer
yeah.
the balance for another 12 months
Yep.
or 9 or 10 months at 0%. And yeah, there's a fee attached to it, but it's well worth doing so.
Oh
And
yeah.
just playing with other people's money is a smart strategy as well. Giving yourself
No,
that benefit.
I'm big in that. And then you get the
Awesome.
rewards points. I mean, there's like I said, when you ask me about, can you live tax free? I think we've kind of gone over tax credits, credit cards, buildings. I mean, if you do those three things, which most people are already kind of doing, you just need a little guidance. You can easily not pay taxes or pay very little, I should say.
Now, here's something. There's something on a restaurant chart of accounts. Maybe not every restaurant, but I certainly had it, and it was called sales discounts. And that was something that was sold for less than full price. And then there's also comps when, this person didn't like their meal and I had to take it off their check. Is there a way that we can capture a benefit for that at the end of the year? Because that adds up significantly, especially if it happens on a daily basis in your operation.
Yeah. Oh, you should be. For the client, for the restaurants that we do bookkeeping for, we capture every single one. You offset it against your income. So your POS system, like a lot of us there's Toast, Aloha, Square now. I mean, there's a ton of them. Spot On's another one. It should give you a printout at the end of the night or the month you choose, and it'll give you those discounts. Your accountant should be capturing all of those. So that's one. Same thing with comps. You have to enter in, that you comped a meal. And if you're doing your bookkeeping, or if your bookkeeper's doing it, not you, because as owners, and I'll give you guys a secret, I actually don't do my own bookkeeping. It's not that I can't. I'm very well capable of doing it.
Of course.
Is that if I'm going to ask somebody else to do my books, or if I'm asking somebody for me to do the accounting, I then can't be a hypocrite and say, oh no, I'm not going to, but I'm going to do my own books to save money. No. So every restaurant owner should be outsourcing it. That, to me, that's mandatory. That's not even a question. And we actually make it a rule in our office that you have to have an accounting software. If you don't have QuickBooks, if you don't have Xero, if you don't have Wave, we actually can't even talk to you, because we're not even going to get the right information to give you the best benefit. So we want to do it for your benefit so that you guys get the best benefit from us.
Can you explain, because for many, many years, we had a benefit because we had S corps. And based on our tax position at the end of the year, there was something called basis that would accumulate. And based on basis, we could take shareholder distributions without paying tax on it out of the company. Now, my businesses were seasonal. They were open, say, 4 months a year. And then there were 8 months a year that my partner and I still paid ourselves. And a good chunk of that time, we took distributions based on our operating performance. But not everyone does that or even knows what it means. Can you explain basis and what a distribution is and how you can legally take that if it works for your tax situation?
No, that is very true. So it's funny that you said I have 2 restaurant owners I can think of now. They just take a W-2 check. Now they're open all year round. And I said, why don't you guys take a distribution? They're like, no, we don't need any more. So I'm like, okay, I can't make them. But to get back to basis, an easy way to say it, because there's all kinds of different accounting terms. The way I like to tell people is it's your equity in your business. So basically it's if the restaurant were to close today, or any business, if you were to close up shop, what would you walk away with, right? How much cash in the bank, how many assets do you own? And if you have basically money in the bank, like you said, you can take a draw or distribution, and you could take that tax-free up to your percentage. So if, let's say you, Roger, and me, if we owned a restaurant 50-50 and there's $100,000 in the bank and we want to take a $20,000 distribution, I take 10, you take 10.
Yeah, it's got to be equal based on the percentage of partnership. Yeah, gotcha. Exactly. Okay.
But basis, I would say, is kind of like what your restaurant is worth or business is worth at that time.
Okay.
That's the easiest way I would do it. There, like I said, there's like debt basis, shareholder basis. There's different forms, but for the most part, it's how much do you have in the bank or what's your equity worth. And for all of us that don't know, it's kind of like you want to look at your house, right? What's your house worth minus what you owe. The difference is your equity. So the basis of your house would be that same thing in your restaurant.
There could be some confusion between a calendar year and a fiscal year when a company first sets up its books. Can you explain the difference in how you like to work and what makes more sense for, say, a restaurant?
So if you're going to be an S corp, like kind of like you mentioned, you have to have a calendar year. So that means your tax year ends December 31st, starts in January, ends in December, like the traditional, the ball drops and all that stuff.
Yes.
The year starts when they kick off the Rose Bowl, the end of the year when they drop the ball. So that's that. Now, some companies, they will elect to be a fiscal year. So what you said, so like you can actually run your tax year from like July to June. Now, the reason why some people might do something like that, or you could do September, is maybe you're a restaurant in Martha's Vineyard, right? And everybody comes there basically from like, or Long Island out there, like out there in the Sound. Your busy time is from Memorial Day to Labor Day. So that's when you would do your taxes. It would end, September 30th, something like that. So that would be a reason why you would do that. And then your tax return would be due in, if my math is right, like January.
Oh, gotcha.
So that would be why somebody would do that. And a lot of businesses do that. A lot of retail businesses, their year ends in April because Christmas is their big time, or their Christmas is their Black Friday. A lot of schools will do that. They'll have their years go from July to June because that's when the school year gets out in June. So there's all kinds of benefits to that. I would say mainly for restaurants, the biggest one is if you have like a touristy restaurant and you're, like I said, you're in Maine, New England, or probably even parts of Washington, I'm sure, that are like that, where you have that seasonality. And after September, maybe you close up, maybe you just have it slower. So that would be one reason why you would do something like that.
Terrific. That's great. We've covered quite a bit of ground today, JT. Have we missed anything? Yeah. Anything else you can tell our audience that might help them?
I think the biggest thing, what I actually want to do for our audience, I think we had talked about, and we'll put the show notes in everywhere. So we have a landing page for you guys. It's jtpells.com/rockstars. And there you can download a free ebook. It's tailored specific to the restaurant industry.
Thank you. Awesome.
And then you'll know basically the top 5 tax breaks that you guys can get. Some of you guys may be taking them, some of you aren't, but there's always something in there. And then, the biggest thing is make sure you talk to your CPA before tax time and ask them, is there anything else I can do? Because I will tell you this, CPAs, accountants, they will not tell you what to do. They will just take your reports, do your taxes, send you on your way. And then when you get a big bill, you're like, there's nothing else I can do? And typically there is, like I said, there is something. So no, I've enjoyed today. And like I said, make sure you download that ebook. I know it'll be in the show notes. It'll be in the description and all that stuff.
Absolutely.
But if you guys are listening, jtpells.com/rockstars.
Oh, that's so generous of you. Thank you so much for your advice, your insights today, and the expertise. I learned a lot. You gave out some huge nuggets, how people can obviously live tax-free and even reduce their taxes significantly. The kid thing was awesome. So tremendous value.
It's a good one.
Yeah. Well, it's been my pleasure, JT. Thanks for being on the podcast.
No, thank you, Roger. I appreciate it.
Okay, audience, thanks again for tuning in. That was the Restaurant Rockstars Podcast. We can't wait to see you in the next episode, so please stay tuned and stay well. Thanks, JT. Gosh, what an impact you're making in this industry and for our audience. It's amazing that you can look at someone's taxes and say, hey, I could probably save you tens of thousands of dollars at the end of the year. And all the things that you might be missing that are legitimate, not crossing any illegal boundaries, but just literally saving you money. And like you like to say, you work your ass off in this business. Why not give yourself every advantage and make yourself as much money and keep as much money as possible? So amazing advice today. Thank you so much for being a great guest on the podcast. Thank you to our sponsors again of the show. And thank you to our audience, as always. Can't wait to see you next time, so don't miss it.
People go to restaurants for lots of reasons. For fun, celebration, for family, for lifestyle. What the customer doesn't know is the thousands of details it takes to run a great restaurant. This is a high-risk, high-fail business. It's hard to find great staff. Costs are rising and profits are disappearing. It's a treacherous road and smart operators need a professional guide. I'm Roger. I've started many highly successful, high-profit restaurants that I've now sold for millions of dollars. I'm passionate about helping other owners and managers not just succeed, but knock it out of the park. I created a game-changing system, and it's filled with everything I've learned in over 20 years running super profitable, super fun restaurants. Everything from creating high-profit menu items and cost controls to staff training where your teams serve and sell, to marketing hooks, money-maximizing tips, and efficiencies across your operation. What does this mean to you? More money to invest in your restaurant, to hire a management team, time freedom, and peace of mind. You don't just want to run a restaurant. You want to dominate your competition and create a lasting legacy. Join the Academy and I'll show you how it's done.
Thanks for listening to the Restaurant Rockstars Podcast. For lots of great resources, head over to restaurantrockstars.com. See you next time.